Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're diving deep into, well, a question that might surprise you. Can a century-old utility company, quietly become one of the most critical players in the next tech revolution? Especially with all this demand from AI and data centers, we're going to unpack that. Our focus today is Dominion Energy, Inc., trades on the NYSE, ticker D. And just so you know, our analysis is anchored to August 8th, 2025. Closing share price was $61.81. Our mission, as always, is to give you that comprehensive data-driven analysis all through the lens of long-term value investing. We want you to really get this crucial player.
And it's timely, too. Just last week, August 1st, Dominion reported their Q2 earnings. They hit expectations, delivering operating earnings of 75 cents per share. Revenue was $3.81 billion. And importantly, they reaffirmed their full-year 2025 operating EPS guidance. So that gives us a solid current picture to work from.
Right, a good baseline. And also, a quick heads up for everyone listening, we are planning to cover Dominion's next earnings release within minutes of it hitting the wire, so definitely stay tuned for that immediate analysis. Okay, let's begin our deep dive. We're starting with part 1, the core business and management's vision. So first up, chapter 1, business analysis. To really get Dominion, we have to understand the basics. How does a regulated public utility like this actually, operate?
Well, at its core, Dominion is basically a government-sanctioned monopoly in its service areas. That means no direct competition. But the trade-off is state regulatory bodies set the rates they can charge. Think the Virginia State Corporation Commission, for example.
Okay, so they set the prices.
Exactly. And those rates are designed specifically so Dominion can recover its costs and earn a fair return on its investments. That structure leads to, well, incredibly stable and predictable revenue. It's the nature of the beast.
It's less about fighting for customers, more about providing an essential service reliably. And they make money in a few key ways, right?
That's right. The biggest chunk, about 68.5% of their revenue, comes from Dominion Energy Virginia, or DEV. It's a vertically integrated electric utility, serves almost 3 million customers in Virginia and parts of North Carolina. And critically, this segment includes Northern Virginia's data center alley, world's largest data center market, still growing fast.
Okay, so that's the big connection to the tech revolution we talked about. It makes Dominion potentially pretty central to the whole AI infrastructure build-out. What about the other parts?
Next up is Dominion Energy South Carolina, or DESC. That's about 23.3% of revenue. They do both electric and natural gas down there. And then the smallest piece, around 7.5%, is contracted energy. This includes assets like the Millstone nuclear plant and more than 50 solar facilities. They sell power under long-term contracts, adding another layer of predictable income.
It sounds like they're really shifting strategy, though, not just sitting back.
Oh, absolutely. That's a really key part of the story right now. Management's been strategically selling off non-core natural gas assets. Think sales to Berkshire Hathaway and Bridge. That helped cut their debt by something like $21 billion. Significant. And the idea is to sharpen their focus purely onto the regulated electric side, because that's where they see decades of growth ahead, driven especially by those data centers.
So the core products are still electricity, natural gas, but the service is reliable, affordable, and increasingly clean power, plus maintaining all that infrastructure.
Exactly. We're talking huge scale, 30.3 gigawatts of generating capacity, over 10,000 miles of transmission lines, almost 80,000 miles of local distribution lines. It's massive.
And so their market position is defined by that scale, but also that unique geographic spot in Northern Virginia. What's the value proposition then for customers and for investors?
For customers, it's pretty straightforward. Reliable power, hopefully affordable. For investors, you get the stability of that regulated model, predictable returns, historically a reliable dividend, plus this unique growth angle tied to electrification and, the data center boom.
Okay, let's zoom out a bit. Let's talk industry analysis. The utility sector.
Yeah.
It often feels slow, but it seems like it's changing fast right now.
It really is, undergoing a pretty profound shift. We're seeing this explosive surge in electricity demand. Just look at PJM Interconnection, that's the grid operator for a big chunk of the East Coast, including Virginia. They're projecting average peak load growth of 6.3% annually over the next decade in Dominion's main area.
Wow, 6.3% annual growth for a utility. That's huge. Driven by EVs, heat pumps, but mostly data centers and AI, right?
Precisely. The digital economy is the big driver there, no question. And at the same time, you've got this powerful push towards clean energy. Dominion itself has a net zero by 2050 goal, investing heavily in renewables.
Now, competitively, you said they're a monopoly in their service areas, but how do they stack up against peers when investors are deciding where to put their money.
Right. In the capital markets, they compete against other big regulated utilities. Think Duke Energy, Southern Company, AEP, Sempra, Dominion's market cap, its PE ratio, dividend yield. It puts them right in the mix.
Ah,
Solidly positioned among those peers for investors looking for, stability and income.
and the regulatory side is always key for utilities. How's that environment looking for Dominion currently?
Right now, it seems largely constructive. Regulators in Virginia and South Carolina appear to recognize the need for massive investment in the grid to meet this future demand. South Carolina, for instance, recently authorized a pretty favorable 9.94% return on equity. But, and this is important, that dependence on regulators is also a primary risk. A shift in the political climate could definitely lead to less favorable outcomes down the road.
Makes sense. And barriers to entry.
Mhm.
Could someone just build a rival power grid?
Huh. Not really, no. The barriers are just incredibly high. It creates what analysts call a deep and wide economic moat. You need immense capital, tens, hundreds of billions for new infrastructure. Then there's a regulatory side. Getting permits can take decades. Literally. Plus, they already have the wires and poles in place. Building a parallel system is just economically, logistically, almost impossible.
That's a powerful advantage. Let's dig into Dominion's overall competitive advantage. Beyond those high barriers, what else makes them stand out?
Well, first, there's brand strength and economies of scale. They've been around over a century. Their name is electricity in their regions, and that huge scale lets them spread their massive fixed costs over millions of customers, which helps keep per-unit delivery costs down.
And those switching costs you mentioned.
Yeah, for customers, they're basically infinite. You can't just decide to get your power from someone else tomorrow if you're connected to their grid. That captive customer base gives them incredible revenue stability. Almost guaranteed, really.
Now, this sounds really key. They're unique assets.
It really is. That strategic geographic monopoly in Northern Virginia, right where all the data centers are congregating, that's arguably their single most valuable unique asset right now. Huge growth driver. Then there's their push into offshore wind with the Coastal Virginia Offshore Wind CVOW project. That makes them a first mover in a really important new renewable area. And finally, don't forget their reliable nuclear fleet Millstone VC Summer. These provide stable, carbon-free baseload power, which is becoming more and more crucial as we add intermittent sources like solar and wind.
Okay, let's shift gears. Chapter 2, Management Evaluation. Robert M. Blue has been CEO since late 2020, chair since early 2021. How's his tenure been viewed?
His time has really been defined by this major strategic shift, pivoting the company towards purely regulated electric infrastructure has been decisive. And his background, lawyer, policy director for a Virginia governor, it's actually kind of ideal for navigating the complex regulatory world utilities live in. They've pulled off those big asset sales, cut debt significantly, and they're overseeing this huge CVOW project, which seems to be hitting its milestones so far.
And how do they handle crises, storms, outages?
They have pretty well-established protocols for storm restoration, customer communication, extensive safety plans for the nuclear plants. It's a very structured operation, as you'd expect.
What about transparency and ethics? How do they score there?
Generally high. They provide good access to SEC filings, earnings presentations. Their corporate values explicitly mention ethics and transparency. They also put out detailed annual sustainability reports. However, and this is a really important counterpoint, Sustainalytics, which is a major independent ESG rating firm, gives Dominion a high-risk rating, 33.8. That puts them in the bottom half of their global utility peers.
So even with their disclosures, external raters see significant risks.
Exactly. It likely reflects the ongoing challenges related to their legacy carbon assets and just the inherent environmental and regulatory exposure of being a large utility. So investors really need to look beyond the company's own statements and consider these third-party views.
That's a crucial point. Now let's talk capital allocation. Where does management actually invest in the company's money?
It's very clear they have this massive $50 billion capital expenditure plan for 2025 through 2029, and it's directed almost entirely towards their core regulated electric business. Think grid modernization, new clean energy like CVOW, solar projects.
So the M&A strategy is more about selling things to fund this investment, kind of the reverse of usual M&A.
That's exactly it. It's classic capital recycling. Sell off non-core, maybe slower growing assets and plow that cash back into these higher growth regulated projects where they expect to earn better regulator approved returns. As for share buybacks, not really happening. The share count has actually been going up slightly. All available capital is going into these growth projects.
But the dividend? That's huge for utility investors, right?
Absolutely. A cornerstone. They have an incredible track record, 390 consecutive quarterly dividends. That's over 97 years. Shows real resilience. The current annual dividend is $2.67 per share, paid quarterly at 17.6675 pasames. But dividend growth is currently paused. Management's prioritizing funding those big investments and strengthening the balance sheet right now.
And how well are they using that capital? What's their return on invested capital, ROIC?
Right now, their ROIC is around 7.1%. That's actually a little bit below the utility sector median, which is closer to 7.4%. This historical underperformance is exactly what the big strategic pivot is meant to fix. By shifting investment into projects with those higher regulator-approved returns, like that 9.94% ROE in South Carolina, the goal is definitely to boost that ROIC over time.
Okay, let's get into Chapter 3. Financial analysis. Quick review of key metrics, market cap.
As of our anchor date, August 8th, 2025, it's about $52.75 billion. So a solid large cap utility.
And revenue growth. Looking back 5 years, it's been a bit inconsistent.
Yeah, it has been, but that's mainly because of those strategic asset sales we talked about. Like, revenue dropped nearly 20% in 2021 when they sold off major gas assets. But for Dominion, investors, and management, the focus isn't really on the headline growth number during this transition. It's about the quality and predictability of the future regulated revenue stream they're building.
Got it. What about profit margins?
Pretty healthy for a utility. For the trailing 12 months ending June 30th, 2025, their operating margin was around 18.3%. Net profit margin was in the range of 16.5% to 17.0%. Shows decent cost control within that regulated framework.
Okay, now this one often trips people up. Free cash flow. It's consistently negative, and significantly so, like negative $7.18 billion in 2024. That sounds bad, but you're saying for a utility like Dominion, it's expected.
Yes, exactly. This is a really crucial point for understanding utilities. For a regulated utility that's investing heavily for growth, negative free cash flow is absolutely expected. It's actually a sign they're executing on their growth plan. All that money going out, that negative FCF, is capital expenditure. It's going into building and upgrading the grid, power plants, things that expand their rate base.
The rate base being the assets regulators let them earn a return on.
Precisely. So every dollar invested, once approved, grows the base upon which they earn future profits. This negative FCF isn't weakness, it's investment in future decades of earnings power.
That's a great clarification. So it's about building future value. Let's talk overall financial stability. How consistent are their earnings?
Well, the official GAAP EPS can bounce around a bit because of M&A impacts, impairments, things like that. That's why management and most analysts focus on operating EPS. It's a non-GAAP measure, but it smooths out those non-recurring items and gives a clearer, more stable view of the core earning power, and that has been more predictable.
And their debt load. Debt to equity looks high, like 1.35 to 1.69 times.
It is high, yes, over 150% debt relative to equity. But again, that's pretty standard for capital-intensive utilities funding huge long-term projects. While the ratio did increase, those recent asset sales were specifically done partly to manage and kind of optimize this leverage. Keep it manageable.
What about the current ratio? Below 1.2 at 0.73 last check. Does that matter?
For a stable utility with predictable cash flow and easy access to capital markets, not really. A current ratio below 1.0 isn't uncommon or necessarily a worry. They just don't need to keep lots of liquid assets on hand like, say, a retailer might.
And finally, stability-wise, the dividend. Still a bedrock.
Absolutely. Those 390 consecutive quarterly payments really speak volumes about their resilience and cash generation. But as we said, growth is paused, held steady at 0.6675 per share quarterly while they reinvest heavily in the business.
Okay, let's wrap the financials with valuation analysis. How does it look on a relative basis, say, PE ratio?
Their current trailing PE is 21.3x. Forward PE looking ahead is about 18.7x. Now, historically, that's well below its 10-year average, which was up over 30x. So relative to its own past, it doesn't look expensive. And compared to its utility peers, it's pretty much in line with the typical range of 17x, 25x. Competitively priced, you could say.
So not screaming cheap, but not wildly expensive either compared to history or peers. What about intrinsic value using a discounted cash flow or DCF model?
Right, so DCF tries to figure out the true worth by projecting future cash flows and discounting them back to today's value. It's about looking past market noise to the fundamental value.
And what kind of value range does that suggest for Dominion?
Based on analyst consensus forecasts and running a standard DCF, the estimated intrinsic value seems to fall somewhere in the range of $59 to $65 per share. And that's broadly consistent with other independent analyses too, like one putting fair value right around $59.71.
What are the key assumptions driving that $59 to 65 range?
The big ones are a long-term earnings growth rate projection of maybe 5% to 7% annually. That's driven mostly by that rate-based expansion from all the investment. And then you need a discount rate. Something like 7.5% to 8.5% seems appropriate, reflecting the lower risk profile of a large, stable utility compared to, say, a tech startup.
Okay, that brings us nicely to part 2, market perception, ownership, and the road ahead. Let's kick off this part with Chapter 4, market sentiment. What's the general feeling about Dominion out there? What are analysts saying?
It's pretty mixed, actually. The consensus seems to hover around hold or maybe a lukewarm buy. If you look at the ratings, about 56% are hold, 40% are buy or strong buy, and only a tiny fraction, 4%, are sell. The average 12-month price target lands somewhere between, say, $59 and $65. But the range of those targets is wide, from $52 all the way up to nearly $70. That really shows the split between the bull and bear views.
Interesting divergence. What about recent news flow? How's that been impacting perception?
Mostly positive lately, I'd say. The narrative is heavily focused on, one, their prime position to benefit from the data center and AI power demand in Virginia, and two, the progress, even with challenges, on that big CVOW offshore wind project. The market also seemed to react pretty well to the Q2 earnings, especially reaffirming the full-year guidance, gave some confidence.
Okay, let's look at some specific market indicators. What's the short interest situation?
It's moderate. Around 3.64% of the float is short. That's about 31 million shares. It's not extremely high, but it does indicate a degree of skepticism out there. The days to cover ratio is roughly 6 to 7 days. So, a sudden positive surprise could potentially cause a bit of a short squeeze.
And technically, how's the stock trading relative to key moving averages?
Pretty strong, actually. As of that August 8th date, the $61.81 share price was comfortably above its 50-day moving average, which was around $57.19. That's generally bullish. And even more significantly, it was well above its 200-day moving average of about $55.59. That gives stronger technical confirmation of a healthier bullish trend over the medium term.
Okay, good technical picture then. Let's move to Chapter 5, ownership structure. Who actually owns Dominion?
It's overwhelmingly large institutions. They hold something like 79–80% of all the shares. We're talking the giants. Vanguard holds maybe 11–12%, BlackRock around 8%, State Street over 5%. That suggests a generally stable, long-term shareholder base. But it also means the stock price can be influenced by big flows in and out of index funds or utility ETFs.
What about insiders, management, directors? Do they own much? And have they been buying or selling?
Their direct ownership percentage is pretty low, actually, only about 0.11%. But the recent activity is quite telling. Over the last 12 months, there's been clear net buying by insiders. Around 80,000 shares bought, net, and even more recently, in the last 3 months leading up to our analysis date, there were 12 open market buys by insiders and 0 sales. That's a strong signal.
Yeah, that skin in the game definitely suggests conviction from leadership. Is the ownership concentrated among those big institutions?
It's fairly concentrated, yes. The top 16 institutions own half the company. The top 25 own almost 59%. So, yeah, the decisions of a relatively small number of large portfolio managers can definitely move the needle on the stock price.
Okay, let's tackle Chapter 6, risk assessment. We can use a SWOT analysis framework here. What are Dominion's core strengths?
Number one is that regulated monopoly model, providing stability. Then that prime strategic location in Northern Virginia near the data centers is huge. They also have a diversified and increasingly clean generation portfolio, and they've shown pretty strong financial management lately, especially getting that debt down.
And the flip side, key weaknesses.
Well, the high leverage is definitely one, that debt to equity over 150%. They're also vulnerable operationally to severe weather. They had a $106 million storm loss recently, for example. There's significant execution risk with huge projects like CVOW delays. Cost overruns are always possible. And as we discussed, that consistently negative free cash flow means they always need access to capital markets.
What about opportunities looking forward?
The massive growth from data centers and AI is the big one. That's a generational tailwind, potentially. Also, the broader clean energy transition, supported by policy, creates opportunities. And advancements in grid tech, battery storage, maybe even small modular reactors down the line.
And the big threats. Start with the general external ones.
The biggest, always for a utility, is regulatory risk. Unfavorable PUC decisions are the nightmare scenario. They can directly hit profits and make it harder to raise capital. Supply chain issues are another threat, especially for big projects like CVOW causing delays or cost increases. And long term, there's always the potential for disruptive technology, maybe distributed generation or something else, to challenge the traditional model, though that seems distant now.
Beyond those, what about macroeconomic factors like interest rates and inflation?
Yeah, direct impacts there. Higher interest rates mean higher borrowing costs for their debt, which can squeeze margins. It also makes their dividend yield look less attractive compared to safer bonds, potentially pressuring the stock price.
And inflation.
Increases their costs, operating costs, construction costs for those big projects. While they can usually recover these through rates eventually, there's often a lag. Plus, if customer bills rise too fast, there can be political pushback against rate hikes.
And finally, one specific geopolitical factor, those U.S.-imposed tariffs of 2025. How tangible is that threat?
It's very tangible, especially for the CVOW project, which relies heavily on global suppliers for things like turbine components and foundations. Dominion actually quantified this in their Q2 earnings. Their current $10.9 billion budget for CVOW already includes $193 million for existing tariffs, and they flagged potential additional costs of anywhere from $31 million to $186 million if tariffs increase further. So it's a real direct financial risk.
Wow, that's a potentially significant hit. Is there any upside or is it purely negative?
It's complex. While tariffs hurt offshore wind costs, broader energy security policies might indirectly support their domestic assets, like nuclear or even natural gas plants. So it's not entirely one-sided, but the direct impact on CVOW is definitely negative.
Okay, let's try and pull this all together. Chapter 7. Conclusion. Synthesizing everything, what's the core bull case for Dominion Energy?
The bull case really hinges on their strategic position. Right at the heart of the AI and data center power demand boom in Virginia, that 6% plus load growth is huge. It gives them a clear path for decades of regulated investment and earnings growth. Management's decisive pivot to pure-play regulated electric, funded by those smart asset sales to tackle the $50 billion investment plan, looks strategically sound. Plus, they're a leader in clean energy transition with CVOW and solar, all built on that stable regulated monopoly foundation with its high barriers and long dividend history.
That sounds pretty compelling. What about the bear case? What are the main counterarguments or risks?
The bears focus on the significant debt load, making the financials sensitive to interest rate hikes. There's major execution risk on that massive CVOW project delays or cost overruns could really hurt returns. Their fundamental reliance on constructive regulators is a constant vulnerability. A negative shift there could be very damaging. And that deeply negative free cash flow means they have to keep tapping the capital markets, which carries its own risks.
So bringing it back to valuation, what's the valuation summary again?
Our DCF analysis pointed to an intrinsic value range of roughly $59 to $65 per share.
And with the stock at $61.81 on our analysis date, August 8th, 2025, what's the concluding outlook?
While the share price falls right smack in the middle of that estimated value range, it really seems like the market is currently fairly balancing those significant, unique long-term growth opportunities against the very real execution, financial, and regulatory risk. So for a long-term, value-focused investor, Dominion doesn't look like a major bargain right now, nor does it look excessively expensive. It seems fairly valued, reflecting that balance of positives and negatives.
Interesting. It leads to a bigger thought, doesn't it? What does all this mean for essential utilities in a future increasingly dominated by data, by AI? How does that tension between needing massive investment and navigating regulatory oversight play out when power demand just explodes? That's a huge question for the coming decades. Definitely something to think about. Now, if you found this deep dive valuable, please do like and subscribe to the Stock Analytics AI YouTube channel. For just €4.99 a month, members get priority deep dives on tickers. And we've got a big plan. Over the next few months, we're covering all of the S&P 500 stocks with exclusive priority access for our members. And hey, if you just want a one-off deep dive on a specific stock you're interested in, drop us a super time. Thanks, we really appreciate the support.
And just our standard reminder, this analysis was generated by an AI system. It's for educational purposes only and absolutely should not be taken as financial advice. Please always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.